Today I'm going to share with you an often overlooked opportunity to take additional tax-free retirement income. So that's what we're talking about with some examples. Let's get going. Let me start by just talking about what scenarios create the most significant opportunity here. So essentially it's anyone who has the ability to create a low amount of taxable income in a given year. Now, there's kind of two ways to do this. On the extreme side, you have people that just live very frugally. In fact, regularly, I see folks that are essentially just living off of their Social Security benefits in retirement. And there is virtually always an opportunity for them to take some additional tax-free income. Now, that doesn't mean you have to be destitute and have no retirement savings. People that have very significant retirement portfolios, including in the multi-seven figures, can also take advantage of this so long as the composition of their savings, allows them to manage their income down in a given year. We're going to see more about how this works in the examples, so stick with me. All right, let's jump right into some examples. And the first hypothetical we're going to look at is a married couple that are retired. They're both age 65. We're going to call them Warren and Susie. Now, despite this being a hypothetical example, I'm just going to add that this is inspired off a handful of real-life cases that I've worked on in just the last couple years. I've changed the numbers, of course, but this is very similar to some actual cases. So, part of my process is always reviewing people's tax returns to understand where their income is coming from and how much it is, because I want to see if there's an opportunity for taking advantage of some of the opportunities as I'm going to describe. So here's the lay of the land for Warren and Susie. Basically, let's just say I reviewed their 2023 tax return, and effectively all that's coming in for income is Social Security. So we can estimate what that's going to be with precision in 2024. Take a look up at the screen. Here is just a mocked up tax return for 2024. And for Warren and Susie, again, both 65, retired. They're only living off Social Security benefits, which we're going to say in this example are $52,000 combined. Okay. The other thing hitting their tax return is they got a couple $1,000s of interest being generated from a high yield savings account. Now, because their income is low enough, take a look at line 6B here. This is the taxable portion of their Social Security benefits. And of course, the number is zero because of their level of income. If you want to know more about how Social Security is taxed, I did an entire video on that, which I'll make sure to link. If you're watching on YouTube, I'll link up in the corner of your screen. If you're watching on one of the other platforms, I'll drop it down in the comments section. But basically, Social Security, the way it's taxed, it just depends on how much income you have. The maximum benefits that can be subject to tax are 85%. We're going to talk a little bit more about that in a moment. But in this first example, they're not paying any tax because of their income. So if we kind of follow the flow through the tax return, their total income for the year is only the interest being generated from that savings account, $2,000. Well, Warren and Susie, they're taking their standard deduction. Remember, in the U.S., everybody can either take a standard deduction here or they can itemize whatever's the greater of the two. For 2024, the standard deduction for folks over age 65, married, is $32,300. So this is enough to wipe out all their income, meaning their taxable income is zero, and of course their tax bill for the year is zero. Now, what this tells me as someone who's doing tax planning is we have a significant opportunity here to take additional income, because as long as our gross income here on line 11 is below $32,300, nothing will be taxable, right? Because deductions offset income. So here is a screaming opportunity to take some additional income on a tax-free basis. Now, let's just assume that Warren and Susie have $500,000 in IRAs. Okay, this is completely comprised of pre-tax money. So given the tax return I just showed you, they are in a position to take some money from those accounts on a tax-free basis. And it looked like that they could take about $30,000 to max out that standard deduction, if you will. The next thing I want to show you is what would happen on their tax return if they did take a $30,000 distribution, because I want to illustrate a common tax trap that has to do with the way that Social Security is taxed. All right, so here's the tax return again. We're changing one fact. Now we're going to take an additional, or we're going to take a $30,000 pre-tax IRA distribution because we think we can do so on a tax-free basis. So let's see how the numbers have changed here. If we pan down, okay, we still have our taxable interest. On line 4B here, there's that $30,000 IRA distribution, but look what's going on here with Social Security. Now, instead of none of the benefits being taxable, part of our Social Security benefits are being taxable. And this is the tax trap that I wanted to highlight. You have to understand when you're evaluating this opportunity that as your income goes up, more of your Social Security benefits become subject to tax. So this can get people in trouble. If we go down here to line 11, you can see now our adjusted gross income is actually well in excess of our deductions. We're all the way up to nearly $50,000. Again, it's because of the relationship that the tax on Social Security has with other types of income. So the issue is our deductions are only going to offset part of our income, leaving us with some taxable income and a relatively modest tax bill, but one nonetheless that I want to help people avoid. All right, I've made one final adjustment here to show you what the actual opportunity is for Warren and Susie to take that IRA distribution on a completely tax-free basis. So let's take a look at the return. So if we go down here to line 4, line 4B. So there's the IRA distribution. It's $20,486. Now you can see how that's changed the amount of taxable Social Security benefits. But the most important thing is when we add all of our income up, our gross income now is $32,299, which of course is $1 under our deductions. Long story short, our deductions wipe out all of our gross income, so our taxable income for the year in this scenario is zero. Okay, so the bottom line is what I'm just trying to illustrate here is this is the actual opportunity for Warren and Susie to take some tax-free income from their pre-tax retirement accounts on a completely tax-free basis. Now, let me just touch on a few last key points as it relates to Warren and Susie. So let me throw a hypothetical balance sheet up on the screen here, and let's just say this is the composition of their net worth. Very simple, straightforward situation with some cash in the bank up here, these pre-tax IRAs. Susie's got a small Roth, and they own a house completely debt-free. Now, Warren and Susie, as we talked about when we were talking about their opportunity, they can take a little more than $20,000 of extra income on a tax-free basis. And of course, that would be coming out of these IRAs because any dollars that come out of here are taxable. Now, of course, they could just spend the money. That's up to them. Maybe they want to do some traveling or home improvements, whatever the case might be for them. But additionally, here's a couple other planning opportunities that are available. If they like the idea, for instance, of moving some of their pre-tax money down here into these tax-free accounts, what Susie could do is she could do Roth conversions. She could start converting her IRA to her Roth. Okay, and one of the beauties of that, of course, for her is, Roth IRAs are not subject to required minimum distributions. Okay, anybody who owns an IRA ultimately has to start taking distributions. Depends on the year you were born, but it's either going to be 73 or age 75. By, again, gradually peeling some dollars off and getting them into this protected tax-free bucket, Susie could protect a significant amount of her savings from taxation down the road. Now, in addition to that, that would also be an estate planning strategy. Moving dollars out of these tax-free accounts before they pass on to her beneficiaries. So for instance, just say Warren and Susie have a couple kids. What's important to understand is if their kids inherit these accounts, and they are, basically those accounts, because they've never been taxed, they will be taxable to the children when they start taking distributions. Well, one way that, again, Warren and Susie could strategize from an estate planning perspective is they could start drawing down these accounts, again, within that window of opportunity that they have. They could either move the money down here to Susie's Roth, or they could even just start shifting the money up into an after-tax account, whether that be cash or an after-tax investment account. Again, the beauty of that is their children will ultimately receive those assets on a tax-free basis. All right, well, as you can see, because of the way in which Social Security is taxed, and in addition to that, because of deductions, people that are in retirement can have actually a fairly significant amount of income without owing any income tax. And again, as I also alluded to in the examples, frequently people can take more income than they even have on a tax-free basis. But there is some planning and math that has to go in this, especially you got to be careful for running into that tax trap as it relates to Social Security benefits becoming taxable as your income goes up. So this can be worth working with a professional on to make sure you get it right. Software is also very handy to help dial in these calculations. Anyway, I hope this one was helpful. As always, thanks for watching. We'll see you in the next one.